So something you'll see as a theme is that companies are not necessarily going from the private markets to the public markets anymore. There's a lot of discomfort with public filings, the requirements associated with that, and management teams not wanting to have to report quarter to quarter or every 6-month period to 6-month period in that way. And so there's more of a movement to actually stay private. And so we've seen more of growth companies and our ability to profit from an early stage actually being private to private transactions, and we expect to see that continue over time. The share of companies and the share of capital raisings happening in the private space has been growing over the last decade and 2 decades. I think that's in response to regulations around the world coming out of the 1999 to 2001 period. There were a lot of changes to regulations, and so companies, it's less friendly essentially to go public for management teams. It's an easier and better experience to stay private. I think also there's been greater market acceptance of companies staying private for longer periods of time. I think that's going to continue. I don't think that's a phenomenon that's going away, meaning there will be public offerings, but people are able to raise 10, 20, $30 billion in capital in private raisings, and as long as that continues, whether that's a company like Uber, whether that's a company like Lyft, whether it's other types of companies out there, they're going to continue doing that. There's any number of firms which are referred to as unicorns that are sort of these billion-dollar-plus private companies. They're not feeling any pressure or urgency to go public, and so if you want to access those opportunities, private investing is the way to do that.